We'll do a case study on transfer pricing. The requirements of this particular question. Outline the key objectives of a transfer pricing system. Then we have, did I do this case in your class? SSA group. This one. These are products. Do you remember? I don't think so.
No, ma'am.
Okay. So the requirements of this particular question, we see what are the key objectives of a transfer pricing system. It says the management of SSA group have asked you to advise them regarding the appropriateness of the decision. So something to do with what should be the price, suitable price. So that's there in that. Second bit also is regarding the basis of transfer pricing. See, throughout this question, it is all about transfer pricing. Okay, so we can take this to be as an exclusive question on transfer pricing. What's the content of this particular question? Let's look into this one. This is SSA group. You are the management accountant of SSA group, which manufactures an innovative range of products to provide support for injuries to various joints in the body. The group has adopted a divisional structure. Each division is encouraged to maximize its reported profit. Division A, which is based in a country called Netherlands, manufactures joint support appliances, which incorporates a one-size-fits-all people feature. A different appliance is manufactured for each of knee, ankle, elbow, and wrist joints. Okay. So the introduction is about. So this is a group which manufactures innovative range of products for what? To provide support for injuries to various joints in the body. So the joints are knee, ankle, elbow, and wrist. So for this, they are manufacturing these units. A different appliance is manufactured for each of knee, ankle, elbow, and wrist joints. Budget information in respect of Division A for the year ended 31st December 2010 is as follows. Okay, so we see the support appliances are knee, the ankle, elbow, and wrist. The number of units sold are 20,000, 50,000, 20,000, and 60,000. Selling price per unit is given. We see the total variable cost of these products. Each of the 4 support products uses the same quantity of manufacturing capacity. This gives Division A management the flexibility to alter the product mix as desired. During the year to 31st December 2010, it is estimated that a maximum of 160,000 support products. So the total capacity available is 160,000 support product units can be manufactured. The following information relates to Division B, which is also part of the SSA group and is based in distant land. Otherwise, the main unit is located in a place called as Netherlands. Division A, which is based in a country called Netherlands. Another unit of the same organization, SSA group, we see it is Division B, and then Division B is located in based in distant land. Okay. Then we see Division B purchases products from various sources, including from other divisions in SSA group for subsequent resale to customers. Second point, the management of Division B has requested 2 alternative quotations from Division A in respect of the year ended 31st December 2010 as follows. Quotation 1, quotation 2. Quotation 1 has 10,000 ankle supports, 2 has for 18,000 ankle support. Then we see the management of SSA group has decided that a minimum of 50,000 ankle supports must be reserved for customers in near land in order to ensure that customer demand can be satisfied and the product's competitive position is maintained in the near land market. The management of the SSA group is willing, if necessary, to reduce the budgeted sales quantities of other types of joint support in order to satisfy the requirements of Division B for ankle supports. They wish, however, to minimize the loss of contribution to the group. So I'll explain this particular situation. See, as of now, let's read through the other parts also. Then the management of Division B is aware of another joint support product which is produced in distant land that competes with Division A version of the ankle support and which could be purchased at a local currency price equivalent to $9 per support. Okay, so see, mainly we see that there are two divisions. Division A is the manufacturer. Division B requires these support products. Division A has taken up the manufacturing of 4 different types of support joint support products. These 6 are there. The total capacity is 160,000. As of now, are they operating at 100% capacity? 20 plus 50 is 70, 70 plus 20 is 90, 90 plus 60 is 150. So they are as of now operating at a level where they are manufacturing 150,000 units. Available capacity is 160,000. So they will be able to take up the production of another 10,000 units. That's the scenario. So we see that Division B has required for quotations for 2 different quantities. 2 different quotations are placed. One is for 10,000 ankle supports, wherein they do have the capacity to take up the additional production of 10,000 ankle supports along with their regular production and sale of all of them together 150,000 units. So quotation 1, there would be no issue. Quotation 2, 18,000. So what has to be done? So for this particular, if at all, if they have to accommodate this 18,000, so there is mention about the management of SSA group is willing, if necessary, to reduce the budgeted sales quantities of other types of joint support. So any one of these 4 joint support products, they would reduce the production of those units, divert the resources to manufacturing the requirement of Division B, which is 18,000. Anyway, 10,000 they have the capacity. For the other additional 8,000 units, they will have to take up a decision of not producing those products or those units and diverting the resources here. So should they be taking it up or not is the criteria what we have to consider. So that's one set of information. Another part of it says that, see, an alternative solution is also available wherein there is a local supplier in distant land ready to offer these support products at $9 per support. That's another aspect we have to consider. SSA group policy is that all divisions are allowed autonomy to set transfer prices and purchases from whatever sources they choose. So Division A can decide what they want to do. So also B can decide. So there is no compulsion from any of the top management managers or anyone. They have the autonomy to decide what they want to take it up. The management of Division A intends to use market price less 30% as the basis for each of the quotations 1 and 2. So then requirements are given. So according to the requirements, we need to read through the requirements and then take up what has to be done. So we'll put this one in an Excel sheet and take up the solution. The first one, A bit, I will write it here only so that then later on I can drag it up. A, option A, talks about key objectives of transfer pricing system. Were you there when transfer pricing concept was explained in the class? Well, I remember the last classes only Abhishek was there. Nevertheless, I'll just put the slide about transfer pricing system, the concept of it. We'll look into that. What is the concept, and then the concept of transfer pricing. See, in an organization, when there are multiple departments, and one department is the producer and seller of a particular product, which if it is required by another internal department or division, what would be the price at which these materials will be transferred to another internal department? See, the concept starts with since they are already selling these products in the outside market, would they be charging the same price that is being offered to the customers in the external market, or will there be any other concession given? So the concept of charging the same price to what they are charging to the external customer, that has profit margin included into that. And so while transferring the material, should they be considering the profit margin included in the selling price and transfer the material, or excluding that? See, as part of performance management, this is responsibility accounting, performance management. We study this particular concept. See, the divisionalization, when it is taken up, because it is difficult to manage the organization based on its size, when it is divisionalization, see, the criteria for measurement of performance is, see, the authority is delegated to take decisions, yet at the same time there is also accountability for the performance. So ultimately they would be measured um, based on what is their performance. See, at that time, it would not matter whether they were helping another internal department or not. So the evaluation would be based on what is their performance. So here, the consideration about it is an internal department would not work. See, it is again, it all comes back to their performance. So now the selling department will want to charge the same price as they are charging to the external customers, the same price to the internal departments also. But from the other buying department, internal buying department point of view, for them, if a profit margin is added, it would increase their cost. So that's a criteria. Now, if it is a benefit for one department, it is a benefit for the overall organization. If it is a disadvantage or excess cost for one department, it is excess cost for the entire organization. See, ultimately they belong to the same organization. So overall organizational benefit is what is the criteria. So if that is the situation, See, there may be some consideration given to that particular concept. They may come for negotiation in terms of the selling department reducing the price, buying department willing to pay more than the cost price. So we see different types of transfer pricing, um, different types of transfer pricing methods that are followed depending on the situation. So first one, if the external market is a perfect competition which is ready to absorb all the units that the selling department produces, in that situation whatever price is offered to the external customers, same is the price which should be offered to the internal departments also. So the same price, transfer at market price. Second situation, if at all, if they have additional capacity, spare capacity, surplus capacity, let's say on a scale of capacity from 0 to 100%, if they are, let's say they are operating at this particular capacity 60, 70, 80, some percentage, if they are operating, they would have some spare capacity available. If at all, if there is some surplus capacity available, see, because they're operating at this particular capacity, producing and selling products, the selling price would have taken care of the total variable cost, total fixed cost. So total fixed cost is already taken care of. So the unused capacity which is available with them, if they operate at that unused capacity level or surplus capacity, all what they would be incurring is only the variable cost. No more fixed cost will be incurred because it would be the same till they reach the maximum capacity. So no more additional fixed cost, it's only the variable cost. So they can bring down their price as low, the least is as low as the variable cost. Okay, so variable cost plus some amount of profit margin could be their transfer price. So that's a situation where they have surplus capacity available. Let's say if they do not have any capacity available, if there are production constraints, capacity, they are already operating at maximum capacity. In that case, to accommodate the other department, they will have to cut down on the production of the units supplied to uh, external customers. So when they cut down on the number of units produced, they will be foregoing the contribution margin which they are earning from selling those units. So the contribution which is foregone is their opportunity cost. So in this situation where there are production constraints, the transfer price could be variable cost plus variable cost plus the contribution margin foregone. Okay, so that is the transfer price. Production constraints, will transfer price is opportunity cost of lost contribution from other products or extra contribution which would be earned if more of scarce resources were available. So remember these three situations. If it is a perfect competition, same price, same selling price will be charged to the internal department also. If there is surplus capacity, then utilizing the surplus capacity, they would be incurring only the variable cost. So the transfer price could be as low as the variable cost. If there are production constraints or they are already operating at 100% capacity, the price would be um, the opportunity cost plus the marginal cost. Okay, so these methods you remember. The same is explained here as well. See, the cost plus pricing, cost could be the total cost plus profit, or the cost could be variable cost plus profit. Okay, so total cost plus profit is when there is no surplus capacity. If it is surplus capacity available, it is variable cost, marginal cost plus profit margin. Otherwise, if it is perfect competition, market is able to absorb everything, transfer price will be based on the market price. Just remember this part. We'll go back to the case study. The first question is a theory question. What are the key objectives of transfer? See, by way of following transfer pricing system, what what is that they want to achieve? See, what is the objective purpose behind having a transfer pricing system? See, the first important aspect when they are divided into departments, better monitoring of their activity. So each department there is a manager appointed. Manager will look after the requirements and the decisions related to the department, and then he implements them, plans and implements that. So accountability is also brought into picture. So then, if that is the case, what do we understand? What is the objective? What do you think is the objective of transfer pricing system? First one would be about performance management, because um, it is not that anything is produced and to anyone it is supplied. No, it is all based on how they are performing. So performance management is one aspect. So we can write it here as to measure the instead of management, measurement. To measure the performance of each of the divisions, um, transfer pricing system is followed in organization. Then anything else you understand? If it is the benefit of one unit, it is the benefit of the organization. If it is a loss for one unit, it is a loss for the organization. So though we are measuring the performance of individual departments, but ultimate focus is always on um, how the overall organizational benefit can be achieved. So we see that the um, organizational objectives. There's another term which is called as I didn't mention to you earlier also. There's a term called as goal congruence. So what does it mean? See, the goal of the organization, when everybody understands the same goal and works towards the achievement of the same organizational goal, we call that to be as goal congruence. So it is the overall goal of the organization which is focused. See, a balance is brought about. See, if it brings benefit to a department, it is benefit for the entire organization. If somewhere it is impacting any other department, it impacts the in a negative way, it impacts the organization. So um, so there is a balance which is brought about. They go in for discussions, negotiations, so they compromise on the price. It is not very rigid in terms of selling department always charging the same market price to the internal department, or it is compromising on transferring the material at cost price. It is not so. So they come down to discuss these transfer prices, wherein ultimately it is the it provides benefit, or it brings benefit to the overall organization. So that is another objective. Okay. Now, one important point, it is also mentioned in the case study. SSA group policy is that all divisions are allowed autonomy to um, set transfer price. So the decision making happens at the divisional level. So now the strategic level, it need not be bothered about what should be the transfer price. So day in and day out, or decisions at a lower level, the top management is not bothered, doesn't look into those aspects. See, when the departments are or when the divisionalization happens, when they are divided into divisions or departments, each of them has a manager appointed. The manager is delegated with authority. Manager takes decisions for the department, and Along with the authority to take decisions also comes the accountability. Accountability for the decisions that are taken and the way they are implemented. So we see authority and accountability, both of them come into picture. So the top management can be relieved out of those responsibilities. They can focus on other strategic decisions. Okay, so um, the reason why they are divided into departments is to ensure that there is authority delegated as well as accountability brought into picture. So delegation of authority and accountability. Fourth one is about uh, we have observed that division A is in a place called as division A, which is based in a country called Nearland. Division B is not in Nearland. The following information relates to Division B, which is also part of the SSA group and is based in distant land. So we see in this particular example only we can understand that they are located in two different places, two different lands or two different countries. One more important point, as we were reading through that, it says that the we didn't read through that, but see, there is one important point here. CBIT, all profits in distant land are subject to a tax rate of 20%. Tax rate in near land is 40%. There are two different tax rates in two different places. In distant land, the tax rate is 20%. In near land, the tax rate is 40%. So, if revenue is generated in distant land, they are charged at 20%. But if revenue is generated in near land, they are charged at 40%. See, transfer pricing between units located in different countries usually takes place to avail the tax benefits. When it's not that those products are not available in the local market. See, we also see when we have read through that, we did see that there was a local supplier available to provide such kind of products at the price of $9 per unit. We did see that. So division A version of the ankle support and which could be purchased at a local currency price that is equivalent to $9 per support. That is also there. There is availability. Alternative is there. But why would they want to acquire it from near land? Why does division B wants to do so? I think that decision is subject to the tax benefits that can be availed. Okay, so the reason why transfer pricing between units located in multiple countries happens because of availing tax benefit. I hope I am making it clear. Once in a while respond, no, so that I will also feel happy that you are listening. I don't know whether you're listening or not, listening to me or not. Am I audible?
Yes, ma'am.
Did you understand this A bit? Okay. B bit, first bit. B bit first point says that the management of the SSA group have asked you to advise them regarding the appropriateness of the decision by the management of Division A to use an adjusted market price as the basis for the preparation of each quotation and the implications of the likely sourcing decision by the management of Division B. Your answer should cite relevant quantitative data and incorporate your recommendations of the prices that should be quoted by Division A for the ankle supports in respect of quotations 1 and 2 that will ensure that the profitability of SSA group as a whole is not adversely affected by the decision. The concept here is the management of SSC group have asked you to advise them to the appropriateness um, of Division A to use an adjusted market price. What is that adjusted market price? Last paragraph here it is seen. SSC group policies that all divisions are allowed autonomy to set transfer prices and purchase from whatever sources they choose. The management of Division A intends to use market price less 30% as the base. So whatever price they are offering to external customers, on that they want to reduce give a 30% discount or rebate, reduce the price by 30% and use that as the transfer price. Now, is it appropriate? Is it appropriate to reduce the market price by 30%? So that's what is asked. Management of Division A to use an adjusted market price as the basis for the preparation of each quotation and the implications of the likely sourcing decision by the management of Division B. Your answer should cite relevant quantitative data and incorporate your recommendation of the prices that should be quoted by Division A for the ankle supports in respect of quotations 1 and 2 that will ensure that the profitability of SSA group as a whole is not adversely affected by the decision of the management of Division B. How many quotations did Division B submit? There are 2 quotations Division B has submitted. What products do Division B require? What do they require, Division B? The management of Division B has requested 2 alternative quotations for ankle supports. Do you see that? Ankle supports. So, they want 10,000 units of ankle support. That's first one. First quotation. Second quotation is 18,000 units of ankle support. Okay. So ankles are, as of now, they are producing 50,000 units of ankle support and selling them to their external customers. Selling price charges 15, present selling price, the market price of ankles. That's right. Market price of ankles is how much? 15 less less 30% discount. We want to reduce that by 30%. Is equal to so market 10.5. So they want to charge a price of 10.5 to the to division B. So market registered price is 10.5. Otherwise, they are charging 50. You can see this. Is this clear?
Yes, ma'am.
Okay. Now, so the question is asking about, is it okay if they use the market adjusted price? You have the management services group has have asked you to advise them regarding the appropriateness of the decision to use an adjusted market price as the basis for the preparation of each quotation. What's the first quotation? The first quotation has 10,000 ampères. See, right now the total capacity, total available capacity, let's put this one here. In units, each one of them requires the same capacity to produce. So all of them together, it is 160,000 less utilized capacity. See, right now, though, we see that it would be 20 plus 50 plus 20 plus 60. So that's coming up to 150. Just now we've done that. So here it is 150,000 units. So surplus capacity is 10,000. Surplus capacity is 10,000. Other additional information. Let's also highlight that part of it. Now we have to discuss whether reducing the price to 10.5 from 15, would it be feasible for them? So that is what we have to discuss. What other quantitative information do we have? We have selling price is given. We also have the variable cost. Variable cost is given as total variable cost. Let's present it as variable cost per unit. Let's have a table because later on also we need to have this table for certain other calculations. But right now I'm putting all these details for all the 4 products. First one is knee. Then we have ankles. Then we have elbows. The final one is wrist. Sales units. This is 20,000. Then we have it as 50,000. Then we have it as 20,000. And then comes 60,000. Already we know what is selling price per unit. Selling price per unit is 24. Then we have 15. Then we have 18. Then we have 9. Variable cost per unit is what we need to know. So variable cost per unit, because it's total variable cost given. So let's take the total variable cost is equal to 200,000 divided by the total number of units. Gives us variable cost per unit. Okay. Now here it is equal to 350,000 divided by 50,000 units. So that's variable cost per unit. Here it is 160,000 divided by 20,000, 8. And here it would be 240,000 divided by 60,000. Okay. We can also find out what is contribution margin per unit. So contribution per unit is equal to 24 minus 10. Now this is the quantitative information we have. Now, if they want to bring down the price, we are focusing only on ankles because this is the criteria, they require ankles. So look at this particular column alone. Though I wrote the details of all the columns, because later part we need this information. That's why I wrote it once for all. So look at only the ankles column. See, is it okay if they bring down the price from 15 to 10.5? That's the question. B bit first, requirement B under that subsection 1. Any opinion you have or any answer you have to contribute? Will it be okay to reduce the price to 10.5? External customers, they are offering 15. Internal division B, will it be appropriate to charge 10.5?
I guess no, ma'am. No, we can.
Why? Just, I mean, justification also is okay. So in situations where they have surplus capacity, their price could be as low as marginal cost. 3 different situations are discussed. When it is perfect competition, same transfer price should be offered as the same market price should be used for transfer price also. If there is surplus capacity available, they can bring down the price as low as marginal cost. If they have production constraint, while deciding the transfer price, they should also consider the opportunity cost of the contribution that is foregone. Right now, we are at this particular second situation where there is surplus capacity. I'm going back to the Excel file. We did mention that there is surplus capacity of 10,000 units. So in case surplus capacity is 10,000 units, consider what's their variable cost. Variable cost is 7. They want to charge a price of 10.5. They want to charge a price of 10.5. 10.5 is definitely greater than 7. Therefore, it is appropriate because they still will be making a profit margin of $3.5 per unit. If at all, if they utilize that surplus capacity available, and this will be applicable only for quotation 1. There are 2 quotations in this question. The division B has 2 different quotations placed. Quotation 1 has the requirement of 10,000 ankle supports. Quotation 2 has the requirement of 18,000 ankle support. Okay. So if we talk about the first quotation 10,000 capacity, they do have that. So they do have this surplus capacity available. If they take a first quotation and charge a 10.5 price, also is appropriate. They still will be making a profit because at this point we see that the variable cost is 7. What's the logic behind that? I hope you understand that, or you want me to explain why do we have to consider variable cost? Do you understand why are we considering marginal cost? You want me to repeat?
No, ma'am.
Okay.
We understood.
Okay. So requirement B, subsection 1. Requirement B, subsection 1 is asking us, okay, advise them regarding the appropriateness of the decision by the management of division A to use an adjusted market price as the basis for the preparation of each quotation. We are also asked to provide relevant quantitative data. Okay. and incorporate your recommendation of the price that should be quoted by division A for the ankle supports in respect of quotation 1 and quotation 2. That will ensure that the profitability of SSA group as a whole is not adversely affected by the decision. Now, first quotation is fine. But second quotation, they do not have the capacity to manufacture 18,000 ankle supports. So when they do not have the capacity, there is a production constraint. When there is a production constraint, now it should be, how should it be looked at? The transfer price will be the variable cost. The variable cost is 7 plus the will 10.5 be suitable in such situation? See, additional 8,000 units, what can they do? The situation only explains that. This paragraph, the management of the SSC group is willing, if necessary, to reduce the budgeted sales quantities of other types of joint support in order to. So, among the 4 products, they will have to now reduce the quantity produced and supplied to the customers of these products, any one of these products. Before this paragraph, the previous paragraph says that right now 50,000 ankle supports must be reserved for customers. So there can be no change in the number of ankle supports produced and supplied to the customers in near land. So they cannot cut down on the production of ankle supports, production and supply to the customers in near land. So ankle supports is ruled out of it. So some other product production has to be cut down. They have to stop producing and supplying 8,000 units because 10 is anyway availability is there, 8,000, and divert or allot those resources to the manufacturing of that additional 8,000 ankle supports. I hope I made it clear the question. Now, looking at the quantitative data for question, first let's finish with the quotation one. For quotation 1, the market adjusted price of $10.50 per ankle support is appropriate as it is higher than the marginal cost or the variable cost per unit. But now if we have to talk about for quotation 2, is it appropriate? That we have to now figure it out. So is it appropriate or not? Now this a lot of decisions involved here. It is not as simple like we have looked at the variable cost and compared. Now the production of anyway ankle supports, nothing can be done because they have to produce and supply 50,000 units to the customers in near land. So next in order, which one? The decision is about which product production will be cut down by 8,000. Look at this table and tell me, you have any opinion about that? So now we are left with knee, elbow, wrist. What do you think? Which one should be reduced? Which of these products production should be reduced? Any opinion? Ankles is ruled out. Ankles is ruled out. Now the decision is between knee elbow or wrist, and why? Hafshan, Praveen, I should not be asking questions. Anyone listening to me?
Yeah, I'm there, ma'am.
Okay.
Sorry, I just my
I saw
network
that.
got disconnected, ma'am.
I saw that. No, I was calling out Afshan and Praveen. None of them were responding, and then I was looking at the participants list. You joined just now. Ankles is ruled out. They cannot reduce the production of ankle. So now a decision is between knee or elbow or wrist. Any of these products production has to be cut down by 8,000 units. For quotation 2, 18,000 units have to be supplied. 10 anyway capacity is there. Another 8,000, they have to cut down on the production of any of these three products. Which one should be selected for cutting down on the production? Okay, I will only give you. So whichever is um, has least profitability, the one which has low profits earned, I think that product production can be cut down. That will be the criteria. So contribution margin per unit is calculated. Each unit gives a contribution of 14. Ankle gives a contribution of 8. Ankle anyway is ruled out. Elbow has a contribution of 10. Wrist has a contribution of 5. Least profitable. Least contribution that is offered is 5. So the decision will be about cutting down the production of risk. So if they reduce the production of risk, 8,000 units of risk would be reduced. Production supply would be reduced to the customers in near land. Then they would divert the resources to the manufacturing of ankles and supply to division B. All of them require the same capacity. That's one important point somewhere we've read. Each of the four support products uses the same quantity of manufacturing capacity. So if they do not produce wrist with the same capacity, they will be able to produce ankles. Okay. So in that situation, for quotation 2, what can be the transfer price? So transfer price for additional 8,000 units. Right now, the marginal cost of ankles is $7 plus. What would they be foregoing if they reduce the production of wrist? $5. $5, that is opportunity cost for foregone. Let me put it clearly. Variable cost per unit of ankles. We see it is 7. Contribution foregone on risk is 5. So what will their transfer price be? 12. 8,000 units will be 12. So for quotation 1, 10.5 is appropriate, but not for quotation 2. Quotation 2, the additional 8,000 units will require a transfer price of 12. Dual transfer pricing is also allowed. See, it's not that uniformly it should be the same price. So they also see the two-part pricing. Transfer at marginal cost, fixed sum plus per annum. Okay. So two-part pricing also is possible. So they can also charge it that way. 10.5 is appropriate for quotation 1, but for quotation 2, for the additional 8,000 units, it will be 12. For 10,000, 10.5, 8,000, it is 12. I hope I made it clear.
Yes, ma'am.
That is requirement B, subsection 1. Subsection 2. Advise the management of divisions A and B regarding the basis of transfer pricing, which should be employed in order to ensure that the profit of the SSA group is maximized. Four marks are allotted. What can we write? From department A's point of view, we did mention about the what would be the appropriate price, whether 10.5 is appropriate for first quotation. Yes, it is appropriate. For second quotation, something else we have discussed. So present that in your point, it would be. But here, advise the management of divisions A and B regarding the basis of transfer pricing. So you need to explain what's the basis. So basis will be quotation 1, surplus capacity, availability of surplus capacities. Quotation 2, for those 8,000 units, it is production constraint. So you have to explain what those things mean. Okay, that's all. Just 4 marks are given. From department B, division B's point of view, is it appropriate? Until now, we were all talking with respect to department A, division A. So division A, for division A, 10.5 is appropriate. Then 12 will be appropriate. But from division B's point of view, also we have to talk about what is division B. What alternative does division B has? I have moved the slide to a particular thing. Look into the content which is present there on the screen, not the calculation. You just have to read through this particular thing and then come to a conclusion. So first paragraph talks about providing 50,000 ankles to the customers in near land. SSA is willing to reduce the price, so adjusted market price is 10.5. Third paragraph says the management of division B is aware of another joint support product in the local market which can be purchased at a local currency price of $9 per support. Division B has an alternative source wherein they can buy a similar type of product at a price of $9. What is division A offering? What is division A offering? Division A is offering a price of 10.5. Division B has an alternative to buy it at 9. From division B's point of view, you talk about it. What do you have to say? Am I clear? From division A's point of view, 10.5 was appropriate. From division B's point of view, because they are asking us to talk about how SSA group on the whole will be benefited. Advise the management of both the divisions A and B to ensure that the profit of SSA group is maximized. So overall SSA group is the criteria for us. Please respond, Rohan. Division B has an alternative to buy it at $9. Okay. So when division B is the alternative price, so what will division B do? Instead of buying it at 10.5 from division A, they would rather buy it from the local market
$9.
at 9. Okay, so um, then it is beneficial for division B. Done. So now we have to look at the benefit of the SSA group. In that case, um, is it beneficial that division B buys it from the local market at $9?
Like the cost wise, it's beneficial, ma'am.
Beneficial for division B. What about division A? Division A has surplus capacity of 10,000, no? They could utilize that capacity and make some profit.
Yeah, correct. Yes, ma'am.
Availability capacity is there, so they can utilize this capacity. So for these 10,000 units, would it be feasible if they still bring it down to 9? Bring down this 10.5 to 9? Would it be beneficial? Will they be benefited if they bring down it to 9?
Yes, ma'am.
Yes, they still will be able to benefit because variable cost is only 7. Because variable cost is only 7, even if they bring down it to 9, they still will be benefited. Division B, the least, I mean, the lowest price which they will be incurring will be 9. So instead of buying it from outside supplier, if they buy it from division A at 9, division B will not forego anything, would be the same situation for them, the cost would be same, but division A will be benefited because by $2 per unit, because their variable cost is 7. Okay, for quotation 1, appropriateness is 10.5. Done. But the benefit for the overall, maybe I like below. SSA group will be benefited. That's for quotation 1. Okay, then for quotation 2, they should buy 10,000 units from division A at 9, and 8,000 units they should buy it from outside supplier, because transfer price for 8,000 units, it comes out to be 12. So 12, they cannot cut down on 12, because they would have to forego that from forego the margin on risk, etc. That also all has to be recovered. So in this case, in case of quotation 2, we should say that 10,000 units should be purchased from division A at $9 per unit, and 8,000 units should be purchased from local supplier at $9 per unit. I hope the decisions are clear. So the second bit says what is the basis. Basis is quotation 1, it is surplus capacity. Quotation 2, it is production constraint. So just talk about those things. Explain. Requirement B is clear.
Yes, ma'am.
Requirement C. Okay, now requirement C says that after considerable internal discussion concerning quotation 2 by the management of SSA group, division A is not prepared to supply 18,000 ankle supports to division B at any price lower than 30% below market price. All profits in distant land are subject to taxation at a rate of 20%. Division A pays tax in near land at a rate of 40% on all profits. Okay, so Division A does not want to compromise on the price. The price on all second quotation 18,000 ankles, they want to charge that same 10.5 per unit. Here we need to bring in one more aspect, which is the tax rates. Advise the management of SSA Group whether the management of Division B should be directed to purchase the ankle supports from Division A, or to purchase a similar product from a local supplier in distant land. Supporting calculation should be provided. So let's say that because tax rates are applicable, 20% is in distant land, 40% is in near land. Even if they earn higher revenue in near land, in that situation also the tax rate is 40%. So ultimately, what is the impact, we have to check. See, if it is lesser revenue earned by selling or by transferring the material to distant land, so they would be benefited at a tax rate of 20%. So price is the same 10.5 on all 18,000 units. It's the same 10.5. They do not want to compromise on that. So considering the rate at 10.5, the decision is whether they supply it to division B or they do not supply it. So advise the management of SSA Group whether the management of division B should be directed to purchase the ankles from division A, or to purchase from a similar product from a local supplier in distant land. This is applicable on all 18. This is quotation 2 on all 18,000 units. A wants to charge the same 10.5 on all 18,000 ankle supports. So should B be purchasing at 10.5 from A, the ankle supports, or buy it from local supplier? So that's the aspect. Let's take it up. if ankle support division A at 10.5, because A does not want to reduce anything beyond 10.5 at 10.5. That's situation one. Okay. Situation two is they buy it from local supplier. Okay. If they buy it from division A at 10.5, do they have the capacity to produce all 18,000? No, they do not have the capacity to produce all 18,000. They only have capacity to produce 10,000 units. So additional 8,000 will be um, by reducing the risk production and um, diverting those resources to producing ankles. Okay. If they are buying it from A, two important points. One is, see, we are talking from SSA's point of view. We are not talking from division A or division B's point of view. Question C says, bit C says, advise the management of SSA group. So we are talking about the revenue of SSA group. The other things being constant, the impact is only seen on the sale of risk, and the sale of risk will be compromised. 8,000 units less will be. Elbows will be same, ankles will be same, knees will be same. So we are not bringing that into picture. So that's, as of now, it is irrelevant. The decision would change only in terms of risk. So we are only, what is relevant, we are taking into consideration here. So if 18,000 units are purchased from A will have to cut down the production of 8,000 risks and divert those resources to make ankle. So right now they will be manufacturing only 52,000 of risks. That's one part of revenue. Second part of revenue is for SSA. See, because A will have a revenue, so SSA also will have a revenue. B will be buying from A has a revenue, so SSA has a revenue. So that way we need to understand. The revenue part of it has two aspects. So 18,000 units, 18,000 ankles at dollar um, how much would it be? Less variable cost. Or else we'll make it as instead of revenue, let's make it as contribution. Contribution. So here, if 18,000 ankles are made at 10.5, less variable cost. Let's present it that way. I'm writing it here. Look at the calculation bar. Now here it is 18,000 ankles into the price is 10.5. Okay, minus what's the variable cost? 7, I think. Variable cost of ankles is 7. So the contribution which can be on contribution of profit is 63,000. Now risk contribution will be on risk. Right now, though, they will be making only 52,000. 52,000 risk. Each will be giving a contribution of 5. Total contribution is 323,000. See, Division A pays tax in Ireland at a rate of 40%. So this revenue is generated by Division A. Division A is in Ireland. Ireland has a rate of 40%. Tax rate at the rate of 40%. So on the revenue that is generated, on the profit that is generated, 40% tax has to be paid. Profit after tax. Let's say if ankle support products are purchased from local supplier. No, we need to also see this is the profit aspect from division A's point of view. Right now, division B is also from division B's point of view. Division B is incurring a cost. A is earning this revenue. We are looking at from SSA's benefit for SSA group. So this is for division A. Then cost for division B. Division B is in distant land. If it is in distant land, it will be benefited at the rate of 20%. Benefit for SSA group. If ankle support products are purchased from local supplier, then in that case, what will be the contribution that's generated? So there will be no cut down on the number of wrists that are manufactured. As usual, 60,000 wrists will be manufactured. Um, Contribution on wrist. All 60,000 units at 5. No, the contribution is 5. Yeah, at $5. So A will earn the same revenue and less tax. Tax will be at the rate of near land is 40%. So here it will be 300,000 into 40%. So after tax contribution. Then purchase cost. Now cost for division B, we see that it is not we talk about purchase cost per division B, they would be purchasing at 9. It's not 10.5 because our local supplier is offering a price of 9. So take this price as 9. Okay. So the benefit would be, overall benefit would be 50,400. So benefit for SSA group if they buy it from outside supplier is 50,400. If they buy it from internal division A, the benefit is 42,600. So what should be the decision? Should they be buying from division B, division A, or should they be buying it from outside supplier? Obviously, no. So this is higher. So SSA group will be benefited if division B purchases ankles from local supplier. I hope that's clear. Is this clear? Okay, then I'll put it on hold for 5 minutes. Then we'll join back and then do another case study. Okay. Write a report to the CEO of Time to respond to her instructions for work on the following areas: the award-winning dashboard, the role of management accountant in integrated reporting, calculation of the target cost and fit of this cost within the TQM approach. So the main point here, what we will be learning is about the target cost TQM approach and the cost of quality. See, last APM class, I did discuss about integrated reporting. So that I won't spend a lot of time on that. Briefly, we'll discuss. We have also learned in one of the questions about how to evaluate a dashboard or performance report if it is already prepared. So let's look into that. What is given? What's the criteria given here? Let's also take it up that part of it, and then see. The content is kind of not very lengthy. We'll read through that case first. This is Time, company background, objective and strategy. Time engine product. Um, Time manufactures jet aircraft engines for the commercial aircraft market. This is a whole wide business, although Time's production and development are all based in the country of D-Land. Time is a listed company and its stated overall objective is to be a world-class jet engine manufacturer trusted by our customers to deliver excellent products. Its promise to its shareholders is that it will maximize their returns. Okay. The strategy to achieve this is to use world-class engineering design engines, world-class engineering to design engines and high quality production and customer service in order to drive profitable growth. Recent events. Times share price has recently suffered as a result of the failure of the new engine design, which led to large cash losses and a difficulty in obtaining new financing. There has also been a bribery scandal involving a senior manager and one of its key customers. As a result, a new CEO has been employed and she has begun a major review of systems at Time. You are a performance management expert within Time, and the CEO has tasked you with aiding her with the following four aspects. So there's a performance dashboard. The first area which the CEO wants to examine is the information given to the board for strategic decision making in both the planning and controlling of the business. The government of D-Land has been encouraging information sharing between businesses and has recently sponsored awards for management accounting. The winner of the engineering sector has produced a sample dashboard template with dummy figures for an annual review, and this is given in Appendix 1. The CEO realized that the winner had a very similar overall objective and strategies to Time and wants your report to include an evaluation of why the dashboard was award winning. Okay. She does not want a new dashboard for Time at this stage, but there may be some useful specific comments to make about the contents of the dashboard given Time's recent problem. So, until now, we note down that the times objective, in terms of objectives, we see that they want to be a world class jet engine manufacturer trusted by our customers to deliver excellent products. So the primary objective they put here is about catering to the requirements of the customers. The secondary objective is its promise to shareholders is that it will maximize their return. So we see that two aspects in their objective. One is to cater to the requirements of the customers. That's the first objective. The second, so maybe we can call it as primary. The secondary one is to maximize their profits, returns to the shareholders. The strategy is to achieve this to use world-class engineering to design engines and high-quality production customer service in order to drive profitable growth. That's all fine. What happened at the time? Recently, the share prices has recently suffered as a result of failure of a new engine design. That's the scenario what we are actually now considering, which led to a large cash losses and and now and a difficulty in obtaining new finance. There has also been a bribery scandal involving a senior manager. So there is some difficulty faced right now, which is faced, which time is facing. Um, as a result, a new CEO has been employed and she has begun a major review of systems at time. You are the performance management expert within time, and the CEO has tasked you with aiding her with the following four uh, aspects. The first aspect is about a dashboard. So someone has prepared a performance dashboard, award-winning performance dashboard. So the first area is to examine um, the information given to the board for strategic decision making in both planning and control. The government of VLAN has been encouraging information sharing between businesses and recently sponsored award for management accounting. So the winner of engineering sector has produced a sample dashboard template. These are dummy figures. Now the CEO wants you are a performance management expert. You are asked to review this. Will it be appropriate for time? Okay. So we need to look into that. That's given in appendix 1. The CEO realized that the winner had a very similar overall objective and strategies to time and wants your report to include an evaluation of why dashboard was award winning. Okay, so we need to comment about that. When we look into the appendix 1, this is the appendix 1. Okay. Um, First, we'll read through that and then I will rotate. Once this is rotated, going back is a difficult aspect. I mean, my system doesn't support. So I will rotate it and then we can put that. Second aspect is they want to, now this is about integrated reporting. Last time we have discussed about integrated reporting. So we know that the CEO has also recently been reading about integrated reporting, and in the light of this review of the dashboard, the CEO has also asked you to explain broadly the role of the management accountant in providing information for integrated reporting. So we need to talk about what is integrated reporting. That's the second aspect. Third aspect is about target costing and TQM approach. So what's the concept of target costing? What's the concept of TQM approach? We need to talk about. Fourth one is what are the costs of quality? Four aspects. Okay. Um, I remember pasting this in some. I'm putting this dashboard here, because we need to look into the dashboard. This is the dashboard. Appendix 1, award-winning performance dashboard. This is present. Now, these are all dummy figures. See what parameters are used. We are looking at that. The report has details for 2015, 16, 17, a comparison of 16 and 7, a comparison of budget and the actual. So budget variance is given. Growth from 16 to 17 is given. The budget or forecast for 18 is given. The financial parameters are revenue, operating profit margin, economic value added, total shareholder return, design. So that those are financial parameters. Non-financial parameters under that, we see the design, class leading products in fuel efficiency, noise levels, chemical emissions. Then another parameter is about manufacturing. Under manufacturing, percentage of orders right first time. Then in terms of delivery, the number of deliveries that were on time, or the percentage of deliveries on time is given. What's the market share as percentage of market leader? We see the percentages are given. Commentary. The revenue growth of the business remains strong above the average growth for the sector of 1.5%. Then EVA is a positive and growing indicated increased shareholder value. Healthy and continuing growth in market share reflects an increased number of class leading products and improvements in right on time service to customer. There have been no major new business risks arising during the period, while market volume growth continues as expected. Okay. So there are how many requirements? 4 requirements here. It's a 50 marks question. We need to comment about as much as we can do in this class. We'll carry it forward to the next class, because the areas what we have to concentrate now are target costing, TQM, and cost of quality. I am assuming it should be done, but let's say if we do not finish it by the end of this session, we can, some part of it we can carry it forward to the next class. Okay. Integrated report, we need to talk about it, target costing and TQM approach. As high quality engineering products lie at the heart of Time's competitive advantage, there has been a TQM approach to the management of all resources and relationships throughout the business. What is TQM? The approach of TQM sorry about it. I put another PPT. Sorry. One second. The approach of TQM says that their aim is continuous improvement. Continuous improvement with reference to zero defective products that are to be produced. So there would be no defects or conscious effort put into ensure that errors can be prevented. No defect free production. Okay, so for that they require the participation of all and the management's commitment. Before that, it is Kaizen, but we don't have the mention of Kaizen, so some other context we will talk about it. And in context to quality related costs, there are 4 different types of quality related costs. First 2 are called as costs of conformance. Last 2 are called as costs of non-conformance. Under costs of conformance, it is prevention cost and appraisal cost. Before even the production work starts, it is about prevention cost, like training provided to the employees, then the designing would be taken up appropriately. Okay, product designing, etc. So those things are prevention costs. As the work is being carried on, appraisal cost to check the quality of it, inspection cost, quality inspection on testing cost. After the output is produced, randomly if any unit is tested for its quality, if it doesn't match with the quality, uh, then they have to be reworked. So rework cost, or if it cannot be used, scrap, or those costs are all part of internal failure cost. Then we have external failure cost. So external failure cost is the production, the units that are produced randomly when they are picked up, they are defective. Then defective in and they are also delivered to the customer. So to ensure that the reputation is not affected, they then provide some services to the customers, free of cost. So the cost of providing um, these services of repairing, maintenance, etc., they would come under external failure cost. So these areas we would have to talk about. There is one more concept about what is target costing. Target costing is where the selling price is taken from the market. The selling price is taken up from the market, and from the selling price, the desired profit margin is deducted. Then they arrive at the target cost price and ensure that the cost price matches with the target cost price, the actual cost that is incurred. We'll go back to the question. Okay, so target costing, as high quality engineering products lie at the heart of Time's competitive advantage. There has been a total quality management approach to the management of all resources and relationships throughout the business. Time currently has a project under consideration to develop a new simple jet engine which would compete in the crowded market for small corporate jets. In order to compete in this market, it is believed that a target costing approach to this new engine would be beneficial. The CEO wants you to calculate the target cost gap for the new engine using the data in Appendix 2. Next, she wants an assessment of how the use of target costing would fit within the existing TQM approach for this new engine. Okay, what is there in Appendix 2? Are you there listening to me? I don't know whether it is interesting or boring. What is there in Appendix 2? Appendix 2, we have different costs that are given: competitor price, raw materials, subcomponents, skilled labor, general labor, production overhead, plant profit margin 15%. Notes is given: design and development has cost of 120 million and the engine is expected to sell approximately 1200 units over its lifetime. Sales and marketing costs are expected to be approximately 20% of the selling price. The planned selling price is expected to match the competitor's price with the brand reputation of Time, providing the competitive edge. Appendix 3 has quality costs that are identified. Okay. Let's take this question to Excel. So there's something about cost of quality given. One by one, we will take it up from the Excel file and then answer the question. Can you see the Excel file? The first requirement is write a report to the CEO of time. So what's the format we have to follow whenever a report is written? So we have to address it as um, this is A, requirement A, to the CEO, time engine products. And who's writing? You are writing. From what is your role? Performance management expert. We need to you also have to write the date. So date would be um, whatever is today's, the day when you are writing the exam, whatever is the date. So that date only has to be mentioned. So now the subject line has to be written. What is that they are writing a report about? See, the performance management expert of time is asked to write a report. Report on what? Write a report to the CEO of time to respond to her instructions for the following area of work. Okay. To comment about the different aspects. See, and costs of quality. So the areas which we are asked to comment about, we need to comment about that. First aspect. See, out of the list, the first aspect, if we take it up, the first one is about comment on the award-winning dashboard. See, it's a 15 marks question. Out of 50, 15 marks are allotted to uh, why is this dashboard performance um, why is this performance dashboard award winning? So will it be suitable for them? So this is a dummy dashboard that is prepared. We need to look into this dashboard um, and talk about why is that it is an award winning dashboard. So what aspects you want me to minimize it little then clarity would be left. See, the report for the year to June 2017. Mm. Can you see this one?
Yes, ma'am.
So, any points which you can draw? First, let's focus on the area, the years which is mentioned here. So, look at this one. Then we'll talk about what are the parameters that are used. So, all at one go, we are unable to look into that. So, just talk about this particular thing. So, you think it is good? Some changes can be brought about, improvements can be brought about. Any such aspect what we can look at? So, why would it be a award-winning one? If we talk about why is that it would be an award winning one is, see, um, sufficiently a time period of 3 years is considered. So the performance measurement over a period of 3 years is taken into consideration. That's one aspect of it. Then the current year, see, a trend analysis over a period of time is given. That's very good. Current year, there is a variance analysis given. That's also very good. So the performance measurement in terms of variance analysis is appropriate. There is a forecast for the next period given. There is a comparative analysis of the performance of 2016 to 2017. The time period that is considered, the years that are considered, see, they are worth appreciating. It is not that they are focusing only on 1 year, but rather they are focusing on multiple years. The trend is observed, the variance analysis is noted down, the comparative analysis is there, and the forecast for the next year is given. So, just looking at the timeline, let's make a mention of that. See, I think time will be sufficient only to discuss performance dashboard. Um, So comparative analysis of the current year and the current year with the previous year. The budgeted the budget for the next period is forecasted and provided. So multiple aspects about the timeline, we can see that. Okay, for all on in concern to all these aspects, see it is very good. Then let's go to the dashboard once again. The dashboard has, see, we will focus on this particular first column. The financial aspects, revenue is given, operating profit margin is given. Under financial, there are multiple things which are given in the dashboard. So if we look at the dashboard, see the timeline we have already discussed. So let's focus on the first aspect about is the financial aspect. Under financial, multiple aspects are given. See what do we have under financial? The revenue is there, sales revenue is there. Then we see the operating profit margin is given. So then we see the economic value added. Economic value added is a concept which talks about how much wealth is available to the shareholders after meeting all the expenses and the cost of capital. Then what is the total return available to the shareholders, total shareholder return. So these two variables talk about the amount of wealth maximization or profit maximization or profits or wealth available to the shareholder. This is in general the operating performance of the organization is known. EV and total shareholder return talks about the wealth availability or profit available to the shareholders from shareholders perspective. These are under financial. After that, we also see there is one aspect, there are non-financial parameters. Under that, we see design, then we see manufacturing, then we see delivery. Okay. These are the aspects. So design is one thing. Then design, in terms of design, what let's write about financial parameters first, then come back to design, discuss about them again. Under financial parameters, the operating performance and the profitability of the shareholders. The operating performance is depicted by revenue generated and the operating profit of the company. The EVA and total shareholders written explain the profit shareholders. Then let's go to the non-financial parameters. Let's also discuss about the non-financial parameters. What are included there? Under non-financial parameters, we see design is given. Okay, design. They want to cater to the requirements of the customer. So that's the primary issue here. What we see. Then when we see the design, class leading products in fuel efficiency, noise levels, chemical emissions. Okay. The design part of it, its efficiency will be presented in terms of how much fuel it is consuming, what's the noise level, so what is that they have anticipated, and what is the performance, all that the variances in terms of meeting this category, that's given. Okay, what would be the scenario for the future? All of them are presented in terms of fuel efficiency, noise levels, and chemical emission. So the design is explained in terms of fuel efficiency, noise levels, chemical emission. Fuel efficiency, noise levels, and chemical emission. Then after the design part of it, the manufacturing. See, the manufacturing was about the percentage of orders, right, first time. See, the primary objective is satisfying the customers. So were they able to see, are they flexible enough to cater to the requirements, the customization are they taking up? So percentage of orders right first time. So when they are right first time, it indicates that the customers would be thoroughly satisfied. So customer satisfaction is their primary objective. See, profit maximization is also their objective, but that's a secondary objective. So if it is customer satisfaction, um, whether they have manufactured it right the very first time, if that is given, they will be able to understand that and the primary objective, whether it was met or not. That's one thing. Delivery talks about the flexibility. Manufacturing and providing, it is about customization according to their requirement. Deliveries on time. So when do they want it to be delivered? See, that is an important aspect. Even in our day-to-day life also, if the customer wants it to be delivered immediately, also we see there are businesses ready to provide. So they claim that it will be delivered in 10 minutes, the groceries and all. We have multiple apps which have come up which claim that they are ever ready to provide it within 10 minutes. Otherwise, if it is the products require longer time also, they still do ask the time slot during which the delivery should be made. So flexibility. Now we also see some of the apps are ready to deliver 24/7. Okay, that is also, that talks about accommodating everything according to the requirement of the customer. Flexibility, deliveries on time. Okay, under the non-financial parameters, they are catering to the customization of the customers and the flexibility in terms of delivery. Second aspect, customization of the products according to the requirement of customers. And flexibility in terms of delivering the products to the customers. Now, see, these things will indicate that they are looking at whether the customers are satisfied or not. So these will help to understand the above non-financial parameters. Help to understand their whether the primary objective was achieved or not. Did I make it clear?